the cool thing too is that, the prices cannot get too out of control either, because these tokens are what are called securities tokens. And securities tokens are basically, they follow some very, very strict regulatory compliance. And so what ends up happening is every single year for these properties, we do need to have an evaluation of the price of the property to make sure that that the token price reflects the price of the real estate. And now people can sell it for higher or lower, depending on, the most important thing will probably be ROI, right? The higher the ROI, the more people will want to buy that particular token. The lower the ROI, the less people will want to buy. But essentially, you'll have a guide as to what the price of that cryptocurrency will be based off of that annual evaluation of each property, which is kind of cool.
All right, welcome back, folks, to another RLT Pivot Podcast. My name is Tracy, and I am joined with my awesome co-host, Mr. Dan Janson, and we have an incredible guest that I'm going to let Dan introduce right now. I've been looking forward to this guy being on the podcast for some time, and yeah, I'm super excited. So I'm going to just wheel it down a little bit while Dan introduces him.
Take down the excitement a little bit. Take it down. It's bleeding through the screen, but
yeah.
Good to be back again. We got CEO of ARK Wealth. We've got Gven S with us today. Gven, how are you?
Good, man. Good. Thanks for having me on. Really excited.
Appreciate you joining us. Tell us a little bit about yourself and kind of even just the overlay of what ARK Wealth is, just so the viewers get an idea of kind of what's happening here.
Yeah, so my company, ARK, is a company that's dedicated towards teaching people all things decentralized finance. And that could be, trading futures and all sorts of futures on the blockchain, to providing liquidity, to basically banking on the blockchain, doing borrowing and lending peer-to-peer. And we've been doing that now since January of 2018, so almost 6 years. And we're excited. We got a lot of new tech. I was just watching one of your live evaluation here on the, I think you guys were buying like into the S&P 500 or something. So I was like, oh, cool. I was actually just putting in a trade on what's called a decentralized exchange, or a decentralized futures perpetual exchange, right before I got on here on a new kind of thing that I've been toying around with ChatGPT, just kind of verifying my numbers. So it was kind of cool to see that. I was like, oh, I've been doing that all day too. Except I don't get out like at the end of the market, because crypto is 24/7.
You don't have to sell. I know you're big into decentralized, and some people might be confused of kind of what that is. Why? First of all, I guess, what is decentralized? Why is that important? And you hear it a lot with all the crypto heads, as I call them, but everybody's like, hey, decentralized, this is the key, this is the future. Why is it the future?
Yeah, so decentralized finance, or DeFi, you'll hear me say DeFi a lot today, is really a way for you to basically be your own bank. You don't need to custody your money anymore with any institutions. You don't need to borrow and lend from institutions. You can all do that on chain. And it just gives you that freedom to where, using smart contracts, or contracts that basically execute on the blockchain, given some parameters, you're able to custody your money, and then also have full transparency in what's going on. And that to me is, a really, really big deal, because, when you see, let's say, I don't know, Nancy Pelosi, disclosing her trades after 60 days. And she's already made, God knows how many millions of dollars because of potentially insider trading. I'm not saying that she is, but potentially insider trading.
She's a good trader. I don't know. I think she's really good. She's got a good record.
I know, man. She's better than Warren Buffett and all these guys. But on the blockchain, I'm able to follow certain wallets and see their moves in real time. So there's no disclosures. It's fully transparent. And I really like that, because it allows me to get, more access to more alpha, and it evens out the playing field. Like the other day, Michael Burry put that huge short, right? on the S&P 500. I think it was the S&P 500. And we didn't know until 60 days later. So for all we know, he's already closed the position, right? And so it's really cool to see, like, again, these, some real savvy traders who may have, some knowledge that you and I don't have on chain, and we're able to now see that in real time and go, hey, maybe I'll follow this person, maybe I won't, based on their track record, but at least it evens out the playing field. And that's what I love about DeFi. It allows us to really see all those things and then also be the institution. So like, instead of, the NASDAQ or the New York Stock Exchange, or even in the crypto side, like Coinbase or FTX or Binance providing liquidity, we now have the ability to provide liquidity. And instead of them making the fees on every single trade, we make the fees on every single trade. And that could be anywhere from like 0.05% all the way up to 1%. And that's really how I made a lot of my money on the last bull market, was by being what we call a yield farmer, or a liquidity pool miner, and just understanding how, the new way of finance works. So that's kind of what we do. Hopefully nobody's confused.
You know what? I'm sure that there's going to be a few people that haven't heard a lot of the terms that you've just said that would want it broken down a little bit. And I actually am going to ask a little bit more about the smart contracts and how that whole thing works from an actual operational perspective, and making sure that people actually follow through with the contract and all that. Like, how does it work? Yeah, so it's not even people following through. It's executed based off of parameters, right? So let's say, for instance, right now I just set a limit order to buy Bitcoin at 25.6, right? And so I set up a smart contract, okay, that says, hey, if Bitcoin hits 25.6, then use my USD to buy it. And this is a stable coin, which is a cryptocurrency that is basically pegged or backed 1-to-1 by the dollar. So it now takes it out of my wallet and puts it into basically a reserve account that says, okay, or an escrow account that says, okay, once this parameter hits, then we'll go ahead and use this, whatever, $100,000 to buy Bitcoin, right? And then I also, in the same smart contract, I said, okay, I also want to set a take profit and a stop loss. And so I set the stop loss at 2% because I'm using 50x leverage. And then I set the take profit at 5% and the stop loss at 2%. And I have basically a delta neutral that runs inverse to that. Well, all of those parameters get triggered by smart contracts. So there's no reliability on you figuring out like all this stuff or human error. It's all code, and it all execute as things hit. And it's all happening on the blockchain. So there's no human intervention. It's just running all day long, fully automated.
We have Lucian in the comments, so he's asking, and I think he just had it misconstrued, but so he's saying, if the data is available on the decentralized side, why does it take 60 days for us to find out about it? I'm not sure I quite understand the aspect.
Oh, no. Yes, Lucian, you probably got confused. So it would take anywhere between 45 to 60 days on the traditional finance side, right? Yeah. So like if Nancy Pelosi buys a microchip stock, then she would do that. But on the blockchain, as long as it's on chain, you're able to get access to those wallets with the snap of a finger. I mean, you see it in real time as the trade's going through.
Perfect. Now, Gven, I was going to ask you about the risks with using those smart contracts, because you're saying it's fully automated. So is there a possibility that something could go wrong and it doesn't operate the way that it's supposed to operate? Or, what do you do in those cases?
Yeah. So, one of the things that we teach is how to audit the smart contracts. And there are third parties that are very, very good at this. But yes, there are definitely risks. Usually the risks though happen on more of like the coin level. So let's say, for instance, you've got tomato coin that just got minted. People may be able to exploit the smart contracts by minting an infinite amount of tomato coin and then taking it and selling it on the market and dumping the price. But a lot of those, it's just basically, kind of like back in the day, I don't know if you used to be in crypto back in 2016, 2017, 2018, where we used to see, all these exchanges getting hacked, right? Well, you don't hear about that anymore. And that's kind of what we experienced in DeFi, like a lot of smart contract being exposed or being exploited. But now you're starting to hear less and less of that because they're just getting better at better, and the audits are getting stronger and stronger, and they're learning, where the holes are, and they're just kind of building off of those smart contracts. So any new technology is going to be vulnerable. But in my opinion, it's definitely gotten much, much better over the last year, especially. But there is risk in terms of smart contracts. Also, if you have, let's say, for instance, you put your money into a liquidity pool. If you don't have the right smart contracts in place, plugging a lot of those holes, somebody could exploit it and milk the smart contract as well. So you do have to understand where you could potentially lose your money, and where the safest places are. And that's, again, one of the things that we teach in our course.
Now, I know you were kind of focusing on crypto safety, and I'm sure the safety has improved a heck of a lot since probably it started. But then again, within the last 18 months, you have Sam Bankman-Fried running around, and there's a whole FTX thing. So how do we know what is legitimately a safe coin, a safe investment, where to keep it, where the wallets that we're holding out crypto should be?
Right. Well, listen, FTX, Celsius, Voyager, all these guys, what were they? They were not DeFi. They were centralized finance still. And, people, when they don't educate themselves, they sacrifice their security into others' hands, right? Now, you're not going to see that, let's say, in TradFi, like the stock market or commodities trading or anything like that, because they're highly, highly regulated. But in crypto, you had things like, again, Celsius, FTX that occurred. They were running, some would say very clear Ponzi schemes. I never worried about that because I wasn't in any of those, right? Let's say, for instance, Celsius had a phenomenal borrowing and lending platform where, they were lending, you would put your Bitcoin up and they would lend you USDC, which again is another stable coin, at a 0% interest rate. But I'm sitting here going why would I put, risk in a centralized exchange where I don't see any of the data on chain, because they're just basically putting their money into cold storage, and then it's just a derivative that you may be trading on their exchanges as opposed to the actual asset. Where on the blockchain, I'm actually trading the actual asset, and I'm able to see it in real time. So let's say, for instance, we've got a borrowing and lending protocol called Aave. I'm able to see in real time. I can see, boom, right there on the blockchain. I can go straight to their smart contract and go, wait a second, Aave doesn't have enough money to pay back, the lenders in the event that, Bitcoin goes down. And that's not going to happen because, again, it's governed by smart contracts. So there's gravity that sets in with a lot of these with all of these borrowing and lending protocols that have been highly audited. And they say, look, if you put up Bitcoin and you borrow against it at an 80% loan to value, and it goes down from 26.5 to 25, you're getting liquidated, or a portion of it is getting liquidated. And there is no and, if, or abouts it, because once it hits that price, the smart contract executes, sells your Bitcoin, and makes sure that the lender is paid back. And so these are the things that, 2008 crisis, or, any sort of bubble before in the past is going to really be put at ease with these smart contracts, because you're going to have to play within the rules. Otherwise, you risk getting liquidated or, losing money. And that I've learned those lessons the hard way. Just, when I first got into DeFi, I didn't understand what a liquidation was. I was just like, oh, you can borrow up to 80%. Cool. And then the next day I'm like, wait, why is 20% of my Bitcoin gone? So, but hey, school of hard knocks for me sometimes.
Yeah, that's why you're the expert though, right? So
yes. Yeah.
Yes. School of pain.
Yeah, I have more scars than I'd like to admit in DeFi.
Sorry, were you
I
going to
don't
ask
know if that
something?
makes sense.
Oh, it
No, no,
does.
no, no.
Absolutely.
Yeah,
Yeah. No,
cool.
so where is the if we're not using Coinbase or any of the major ones, where do you actually go to see the data? Where are you able to view the contracts?
Yeah, I mean, like directly on the blockchain. So you can go to like etherscan.io, or a lot of these really good um, DeFi protocols have, their audits posted on their websites. So you can actually go and see what these third-party auditors, and most of them even have like two or three. It's not just like one audit, because if like one doesn't catch something, maybe the other one will. Um, but you'll be able to see these audits on their websites, and you can click through. And a lot of the audits, it's like a pretty straightforward thing, like, hey, this is a code red, type of exploit that can occur in this smart contract. But a lot of them, what happens is once they do get the smart contract audit back, they go ahead and fix it immediately, to avoid any exploits. And they're constantly upgrading these smart contracts, because the last thing you want to do is get have some black hat hacker drain all of your funds or your people's funds, and that has happened when the smart contracts haven't been audited, or they're not very strong to begin with.
Oh, that's very cool. Can we transition a little bit into the utility of actual cryptocurrency for a minute and kind of see where that's sitting now, and how it's progressed over the last several years? Where is that sitting right now?
Yeah, I mean, when you look at it, like for me, the two strongest ones that have utility are Bitcoin and Ethereum. And then there's obviously a whole bunch of layer two cryptos built on the Ethereum network that I think also have a strong use case. But essentially, what's happening is we're building these like new financial networks that use gas or cryptocurrencies in order to pay for these transactions. Now we've got like the Ethereum network, which is probably one of the most widely used ones in the world, especially when it comes to smart contracts. They're probably number one. I haven't checked it in a while, so don't quote me. There's a lot of new layer twos that have come out recently that have grown in popularity, but I believe Ethereum is definitely number one. And basically, what is the use case of it? Well, every single time there's a transaction, you use Ethereum. And the cool thing about Ethereum is about a year and a half ago, they dropped a new release on the code where every single transaction that goes through, a little bit of Ethereum is burnt. And this is now making Ethereum deflationary, as opposed to before it was basically unlimited inflation. And so now, while they still do have an inflationary part of it, so many people are using the network that it's starting to go down. So Ethereum is definitely one of them. In terms of transferring value, Bitcoin is still, right now the king and storing value. People really like that. The Bitcoin network is so secure. But in terms of like use case, Bitcoin is like, meh. I mean, you can't really use it for smart contracts, and despite the fact that the Bitcoin maxis would probably, yell in my face telling me that they can do it, they can't. It's just not. It's not a realistic thing. I've actually used their layer two solutions, and they're very clunky and not so good. But those are the two best use cases. I have another few cryptos where they've got really good profit sharing programs where they're DAOs. So like you come in and you participate, you're able to vote in the direction of the project, and then also any fees that are generated from there, you're able to collect by holding their cryptocurrency. So that's another one. But the thing that I'm most excited about is tokenized real estate. And we actually just launched our first tokenized real estate project last week at a mastermind that I had here in Panama. And the use case that you have in terms of transferring value of real estate is phenomenal, because now you have a sector that used to be very, very illiquid, and now you've made it into one of the most liquid markets into the world. And I believe that real estate is going to boom over the coming years. It's going to be as liquid, actually more liquid than the stock market, and just as liquid as the crypto market, where you're going to be able to go and with a click of the button, take a look at some properties that you may like and that are producing passive income and go, okay, hey, I'll buy that. Somebody's offering it. And you'll be able to buy a fraction of, whatever, a warehouse or an apartment or a single family home. And you'll be just generating that passive income month in, month out. And that's the part that in my opinion is really exciting.
So let me get this straight. You're talking about actually like a real estate trading market where you're getting a partial share in the ownership of a piece of real estate rather than actually buying the physical asset?
That's correct. And unlike
cool.
it's really cool. And some people are like, oh, like a REIT. I'm like, no, not like a REIT. A REIT, you buy a huge property or a huge collection of properties, and you don't really have access to diversification. Where here in this marketplace, again, you'll have the ability to go, okay, hey, I kind of want to diversify myself. I want to have some short-term Airbnb rentals. I want to have some long-term rentals that maybe don't pay quite as much, but are low risk. I want to buy a warehouse. I want to buy, a commercial strip that's paying 12% per year. And so it's really cool. And then all the payouts get paid to you in cryptocurrency in a stable coin. Again, another coin that's pegged to the dollar called DAI. And it just keeps hitting your account month after month once you get buying it. So it's really cool.
Wow.
I know they have that concept already, kind of with like Fundrise. They have Acre Investments, I think. Might be a little different. You could buy partial like rental vacation homes, things like so there's definitely a movement kind of going into the almost crowdfunding investment space, which I think is cool. And I think crypto could give a different aspect to that. But until the part that I think mainstream would be held up at is, number one, besides like the crowdfunding area, or I think people have purchased cars using crypto, things like that. Why would I want to sell my house for crypto if it's going to be as volatile as it has been?
Yeah. So, okay, let's dissect that, because there's kind of two things to that, what you just said. So with this, you're not selling your house for crypto. Like these properties, the first 4 that we just tokenized, we bought in cash, right? And so we sold the tokens though in crypto. So like if you're an individual investor and you're like, yeah, you're right, the crypto market is way volatile and I need to take profit into something other than USD that's going to appreciate and that's going to pay me a passive income, where do I go? Real estate. So now a lot of us that are in crypto, we're like, man, I wish crypto would grow up. Well, now it's growing up, right? Now you're able to take those profits that you made off those trades in Bitcoin and take it into less risky assets like real estate, and you're able to put them in there. So, but there definitely are people that are buying crypto, buying real estate using crypto. Now, here's the thing, and this is where people get mixed up a lot, right? Especially here in Panama, people have what's called stable coins. Again, a cryptocurrency that is backed 1-to-1 by the dollar, such as USDC or USDT. And they're going, hey, you got an apartment here, with a nice ocean view for $1 million. I'll send you $1 million in USDT. And you're able to basically just record that transaction. And it's the best type of transaction because it's on the blockchain and you're able to see it's irrefutable. Hey, Dan sent Gven, $1 million to his wallet. It's there, ready to transfer deed and title. So that, in my opinion, is a much easier way than wiring money because it clears right away. But some people may still decide that they want to wire money. But those are things. But you have to understand the difference. Yeah,
and I think with the smart contracts, I think the importance of that would be cutting a heck of a lot of middlemen out of the transaction. So, there's the mortgage brokers, there's the real estate agents, there's a whole bunch of people involved in the real estate process that I think just banks are involved. Just a whole mess of paper where it's just a more simple transaction of like okay, here's the money, here's the financing, this is what it is, so I think the smart contract cuts down and stores the information. So I think that is a huge valuable area for the smart contracts.
Yeah, no, and we're, like I said, we're seeing it. At the beginning, when we first buy these to tokenize them, obviously that's where the heavy lifting goes in and all the contracts go in. But once that's there, boom, you're able to just buy and sell it like no problem, as long as you have a marketplace. Obviously, that's what you need. You need kind of liquidity. You need buyers. You need sellers. But we're building that little by little. We've got over 1,000 investors in ours, and we're bringing on many other thousands of investors over the coming months. So again, the key thing here is making sure that you have a marketplace. But the cool thing too is that the prices cannot get too out of control either, because these tokens are what are called securities tokens. And securities tokens are basically, they follow some very, very strict regulatory compliance. And so what ends up happening is every single year for these properties, we do need to have an evaluation of the price of the property to make sure that that the token price reflects the price of the real estate. And now people can sell it for higher or lower, depending on, the most important thing will probably be ROI, right? The higher the ROI, the more people will want to buy that particular token. The lower the ROI, the less people will want to buy. But essentially, you'll have a guide as to what the price of that cryptocurrency will be based off of that annual evaluation of each property, which is kind of cool.